For months, I've been building a case on this channel, not based on headlines, not based on sentiment, but based on the physical data that moves underneath the price before the price ever reacts. I told you that the suppression of silver below a critical threshold was mathematically unsustainable. I told you the delivery mechanics were grinding in a direction the paper architecture was not built to handle long term. And today, that case received its most visible confirmation yet. Silver crossed 80, and it didn't cross $80 quietly. It crossed $80 on the exact same day that the IRGC Navy, the Revolutionary Guard Corps, the actual operational body that controls the Strait of Hormuz, issued a statement confirming that commercial vessel passage through the strait would proceed under what they called new procedures. Not a peace deal, not a formal reopening. 2 words, new procedures. The market understood exactly what that language meant. Drop a comment right now, tell me what you're holding, and post the silver price you're seeing at the moment you watch this. Everything in this analysis is recorded as of May 7th, 2026. Silver is moving in real time, significantly, and in both directions over the past 10 weeks. I want this comment section to function as a live tracker for every person who discovers this video over the coming weeks. The more people post, the more useful this becomes. That's the kind of community resource we're building here. Now let me take you through what actually happened, in the exact sequence that makes it meaningful, because the $80 break itself is not the central story. The $80 break is the market confirming, in price terms, a structural thesis that has been accumulating evidence for 6 months. Here's what moved in the last 24 hours. Iran's foreign ministry confirmed it is actively reviewing the latest U.S. framework proposal and will route its formal response through Pakistani diplomatic channels. Separately, and this is the detail that matters most, the IRGC Navy issued its own statement saying passage through the strait would be ensured under new procedures, following the suspension of U.S. military operations in the region. The IRGC did not specify what those procedures involve. They didn't need to. The signal wasn't in the details. The signal was in the fact that the body which physically controls the world's most critical oil choke point said vessels are moving through, not waiting on a signed agreement, not paused pending negotiations. Moving. Trump stated publicly that talks are progressing well and that a final agreement is achievable. Pakistan's foreign minister confirmed active mediation involvement aimed at a permanent resolution. This is where it gets interesting, because those updates didn't all say the same thing. There were 3 separate Iranian entities sending 3 separate signals simultaneously today. Iran's foreign ministry, the diplomatic face, said the proposal is under review. The Parliamentary Security Committee called it an American wish list with no grounding in reality. And the IRGC Navy, the body that physically controls Hormuz passage, said ships are moving through under new procedures. When signals diverge across multiple institutional voices, you don't average them. You read the one that carries operational weight. The IRGC controls the strait. The IRGC said passage is proceeding. That is what oil markets read. That is what silver markets read. That is why silver broke $80 on a day when the official diplomatic headline was still technically labeled under review. Now let me give you the technical architecture, because $80 is not just a round number. It has been a contested structural level for 10 weeks, and breaking it reconfigures the entire landscape of this trade. Silver reached approximately $121.65 in late January 2026. From there, it corrected downward by roughly 44%, reaching approximately $67 to $68 by mid-March. That correction was mechanically induced. 3 consecutive margin hikes nearly tripled the margin requirement on silver futures, forcing billions of dollars in paper liquidation at precisely the moment the underlying physical data was signaling the opposite direction. The Bank of International Settlements subsequently published analysis characterizing that January correction as structural rather than fundamental. The physical demand that carried silver to $120 did not disappear during the pullback. According to that analysis, it intensified, because the forced liquidations created cheaper acquisition prices for buyers with the capital and intention to take physical delivery. After the correction, silver spent approximately 8 weeks building a consolidation range between $70 and $80. Technical analysts tracking the chart structure described the pattern as a tightening wedge, each successive high coming in slightly lower, each successive low coming in slightly higher, compressing the available price range session by session. Tightening wedges have one resolution mechanism, a breakout. The direction remained the only open question. That question was answered today. However, before you interpret $80 as a ceiling that became a floor and simply move on, the analyst targets that were watching this exact level deserve attention. Institutional forecasts from Goldman Sachs placed silver between $85 and $98 under ratio-adjusted December 2026 projections. Deutsche Bank and Citigroup both carried $100 end-of-year targets on the books before the Iran conflict began. Technical analysis of the measured move from the wedge pattern's January high pointed to a $100 to $120 structural target zone following breakout confirmation. These are not my projections. I'm not making a price forecast. But I want you to understand what institutional and technical analysts were watching when silver approached this level, because they were watching the same number, drawing the same structural conclusion. The $80 break is not a one-day news reaction. It is the resolution of 10 weeks of compression. Let me give you the COMEX layer, because this is where the daily price action and the structural picture underneath it connect in a way most commentary skips entirely. As of May 5, 2026, the COMEX registered silver pool stands at 79.59 million ounces. Registered is the critical designation here. This is silver immediately available for delivery settlement, not eligible metal sitting in vaults awaiting reclassification. In the 6 months spanning December 2025 through May 2026, total physical silver demanded and delivered through COMEX futures settlement amounts to 225.9 million ounces. December alone saw 64.7 million ounces delivered. January 49.4 million. February 25.2 million. March 46.1 million. April 16.6 million. And May is still active, with 41.1 million ounces of delivery notices already logged as of May 5th. Place those two numbers in the same sentence. The market has delivered nearly 3 times the entire current deliverable pool across the past 6 months. The monthly average across that window is approximately 40.5 million ounces. The registered pool currently holds less than 2 months of that average pace. This is not an immediate crisis signal on its own. Metal migrates from eligible to registered. New inventory enters the system. The CME has management mechanisms. But the directional trend is unambiguous. More physical silver is being demanded and removed each month than is being returned to the system. The pool has been contracting since October 2025. But here's the mechanism most people watching today's move are missing entirely. The paper market and the physical market have been narrating 2 completely different stories for 6 months. The paper market designated $80 as a ceiling and used margin mechanics to defend it. 3 margin hikes triggered liquidations, paper selling pressure applied at precisely the moments the physical data said the opposite. That combination held the price below $80 for 8 weeks. But every time the paper mechanism pushed the price down, physical buyers used the cheaper levels to stand for additional delivery. The registered pool shrank. The coverage ratio tightened. The available metal backing the paper mechanism grew thinner. The paper mechanism doesn't collapse in a single session. It erodes, session by session, until the pool reaches a level where the next demand wave can't be absorbed. Today's $80 break is the paper mechanism losing one visible public battle. The attrition between paper sellers and physical buyers has been running for 6 months. The current score, 225.9 million ounces removed versus 79.59 million ounces remaining. Now let me add the macro layer, because this is the context that connects the COMEX story to sovereign behavior and institutional positioning simultaneously. The World Silver Survey 2026, published by the Silver Institute in April of this year, confirmed a projected global silver market deficit of 46.3 million ounces for 2026, a 15% increase over the 40.3 million ounce deficit recorded in 2025. This marks the 6th consecutive year in which global demand has exceeded total supply. Since 2021, cumulative drawdowns from above-ground global silver stocks to cover annual gaps total 762 million troy ounces. Silver consumed industrially, in photovoltaic panels, semiconductor manufacturing, medical devices, is not recoverable. It is permanently removed from investable and deliverable supply. Replacing 762 million ounces at current global mine output of approximately 820 to 840 million ounces annually would require redirecting the entire global supply away from all other applications for nearly a full year. That is not a scenario. It is a mathematical impossibility under current production capacity. On top of that structural deficit, the sovereign accumulation data moves this story from concerning to historically unprecedented. In January 2026, Turkey imported 273 tons of silver, a 766% increase year over year, breaking an import record that had stood since data tracking began in 1999. Turkey is a major refining hub at the intersection of 3 geopolitical regions. When it moves 273 tons in a single month, it is executing a strategic inventory decision, not a speculative trade. China imported 836 tons of silver in March 2026, the largest single-month import in recorded history, 173% above the 10-year seasonal average for March. China formally reclassified silver as a strategic material in January 2026, restricted exports to 44 government-authorized entities, and its domestic price has been trading at a 12 to 17% premium above the international benchmark. The world's largest physical silver consumer was simultaneously paying more than the paper market said silver was worth and importing at record volume. That premium is not noise. It is a direct signal that the paper price no longer reflects the price that matters to the world's largest physical buyers. Now let me give you the 3 scenarios from here, because this is not a single outcome environment, and you need the full map. If Iran submits a formal response through Pakistani mediators within the next 48 to 72 hours and accepts the framework's core terms, oil moves lower. The rate cut probability timeline accelerates, dollar weakness becomes the primary driver, and silver consolidates briefly before the structural thesis. The deficit, the vault drain, the sovereign accumulation, reasserts itself as the dominant narrative. In that scenario, the $80 level that functioned as resistance for 8 weeks becomes the new structural floor. Analyst targets of $95 to $104 come into view within the following weeks. If Iran rejects the proposal, or the process stalls and military operations resume, the geopolitical risk premium returns to oil, safe haven positioning returns to silver, and the paper market partially reverses. However, and this is critical, the physical delivery data does not reverse. The COMEX pool does not refill. The China premium does not disappear. Silver finds support in the $72 to $75 range based on monthly technical structure and Fibonacci retracement of the 2025 to 2026 rally. The structural thesis continues running underneath. If a framework is signed but Hormuz negotiation stalls within the 30-day window, the market gets partial relief followed by renewed uncertainty. Physical buyers continue doing what they have done for 6 months, using every paper weakness to stand for additional delivery. The pool gets thinner. The coverage ratio tightens further. All 3 scenarios place silver in the same structural position 6 months from today. The paths differ. The underlying data does not. The 4 numbers I'm watching every session: the COMEX registered pool, currently 79.59 million ounces, with warning thresholds at 77 million and 75 million. The China domestic premium, currently 12 to 17% above international benchmark. The gold-silver ratio, currently compressed to the 59 to 61 range with 55 and 40 as the next significant levels, and the 10-year Treasury yield in relation to equity performance. Watch for 2 consecutive sessions of S&P down more than 1%, while the 10-year sits above 4.8%. That configuration is the early indicator for the next major rotation into hard assets. I'll close with this. The physical buyers in this market have never stopped driving. For 6 months, session by session, delivery notice by delivery notice, they have removed metal from a system that the paper mechanism was defending. Today, that defense gave way at $80. The people who will be asking whether it is too late at $90 are the people watching today and thinking they missed it. They didn't miss it. What they're about to miss is the understanding of why $80 broke, and what the data says about where the price moves next. That understanding is the only durable advantage in any market. This is OG Peter at SilverDispatch. The data doesn't ask whether it's too late. It tells you where the trajectory leads. You decide what that means. Reminder, nothing in this video constitutes financial advice. All analysis is based on publicly available data as of May 7, 2026. Prices are volatile. Verify everything independently before making any decision with your capital.